Have you ever noticed how sometimes the calmest periods are followed by the biggest storms? This isn't just true for weather, it's a core principle of our economy. Today, we are diving deep into a fascinating and slightly scary idea, the paradox of stability. We'll explore how our desperate attempts to keep things stable might actually be setting us up for the biggest crash of all. Let's start with a simple question. If you were in charge of the economy, what would be your top priority? For most policymakers, the answer is stability. No one wants a repeat of 2008. No one wants to see people lose their jobs, their homes, their savings. So, the logical response is to do everything possible to prevent downturns, right? Keep interest rates low, pump money into the system, and make sure the good times keep rolling. This sounds great in theory. It creates an environment where businesses feel confident to borrow and expand, consumers feel good about spending, and stock markets climb ever higher. We get short-term growth, and everyone seems happy. But what's the hidden cost? This is where the economist Hyman Minsky comes in. He had a revolutionary idea that he summed up perfectly. Stability is destabilizing. It sounds like a riddle, but it's one of the most important concepts for understanding modern finance. Minsky argued that long periods of economic calm and prosperity don't make the system safer. Instead, they encourage people to take on more and more risk. Think about it. When everything is going well, memories of the last crisis fade. Lenders become less strict, and borrowers become more ambitious. Everyone starts to believe the good times will last forever. They start making bets they wouldn't dream of making in a more volatile market. This process happens in 3 stages. First, there's what Minsky called hedge finance. This is the safe stage. Borrowers can afford to pay back both the principal and the interest on their loans from their expected cash flow. It's like having a mortgage you can comfortably afford with your monthly salary. Everything is sound and sustainable. But as stability and confidence grow, we move into the second stage, speculative finance. Here, borrowers can still afford to pay the interest on their loans, but they can't afford to pay back the principal. They rely on rolling over their debt, taking out new loans to pay off the old ones. They're betting that the value of their assets, like real estate or stocks, will continue to rise, allowing them to refinance indefinitely. This is where things start to get shaky. It's like only paying the minimum on your credit card, hoping your salary will go up enough later to cover the whole balance. Finally, as the euphoria reaches its peak, we enter the most dangerous stage, Ponzi finance. No, this isn't just about Bernie Madoff. In this stage, borrowers can't even afford to pay the interest on their loans, let alone the principal. Their only hope is that the asset they bought will skyrocket in price so they can sell it to someone else for a quick profit. They are entirely dependent on asset price inflation. The debt itself generates no income. This is pure, unadulterated speculation. The system has become a house of cards, built on nothing but a shared belief that prices will keep going up. So, what does this have to do with our quest for stability? Well, every time the economy shows a sign of weakness, what do central banks and governments do? They step in. They lower interest rates, buy up assets, and inject trillions of dollars into the financial system. This is the stimulus we hear so much about. Their goal is to prevent a recession and keep the party going. But in doing so, they are suppressing the natural cycles of the market. They are preventing the small corrections that would normally clear out the bad debt and risky behavior. By constantly saving the day, they are inadvertently pushing more and more people from hedge finance into speculative and Ponzi finance. They make it artificially cheap to borrow, rewarding risky behavior and penalizing fiscal prudence. Savers get punished with near-zero interest rates, while debtors get bailed out. This creates a massive dependency on stimulus. The economy becomes like a patient that can no longer function without its life support machine of cheap money. This brings us to the great paradox. The very actions taken to create stability are what sow the seeds of a future, much larger crisis. By preventing small forest fires, we allow the underbrush to build up for years, making the eventual wildfire catastrophic and uncontrollable. Every bailout, every stimulus package, makes the system more fragile, more leveraged, and more dependent on the next injection of cash. We are essentially trading long-term resilience for short-term calm. The quiet, seemingly boring decisions made by central bankers in anonymous boardrooms have profound consequences. They are quietly encouraging a mountain of debt that could one day collapse under its own weight. When that happens, we get what's called a Minsky moment. This is the point where the music stops. It's when investors suddenly realize that assets are wildly overvalued and rush for the exits all at once. Lenders call in their loans, credit freezes, and asset prices crash. The illusion of wealth evaporates, and the house of cards comes tumbling down. The 2008 financial crisis was a classic Minsky moment. A long period of stability in the housing market led to the creation of incredibly risky financial products, like subprime mortgages, that blew up the entire global financial system. The response? The biggest stimulus and bailout package in history. We fought debt with more debt. And where are we now? We are arguably in an even bigger bubble. For over a decade, we've had the most aggressive stimulus policies ever seen. Global debt has ballooned to unimaginable levels. Stock markets, real estate, cryptocurrencies, everything has been inflated by this tidal wave of cheap money. We've suppressed volatility so much that any small hiccup now requires a massive intervention to prevent a collapse. So, what's the takeaway here? It's not about being a doomsayer. It's about understanding the system we live in. The pursuit of perpetual stability is a dangerous illusion. Economies need to breathe. They need small recessions and corrections to clear out the excess and punish bad decisions. By trying to eliminate the business cycle, we may be setting ourselves up for a lost decade or worse, a systemic collapse that will make 2008 look like a walk in the park. It's crucial to recognize the fragility hidden beneath the surface of calm. The longer the party goes on, the worse the inevitable hangover will be. The real question isn't if another Minsky moment will happen, but when, and how prepared we will be for it. Understanding this paradox is the first step to protecting yourself and making smarter decisions in a world that is far less stable than it appears. Thank you so much for watching. If you found this explanation helpful, please hit that like button and subscribe for more deep dives into how the world really works. We'd love to hear your thoughts in the comments below. Do you think we are heading for a Minsky moment? Let's discuss. Until next time, stay curious.